It's happening right now. While the mainstream news is feeding you holiday fluff and 2026 projections, the foundation of the entire global financial stack is being shredded. We are watching a structural divorce that hasn't been this violent since 1979. They're telling you the dollar is strong because interest rates are high, but it's a total gaslight. It's a massive smokescreen for a flight to safety that has already reached terminal velocity. Look at the numbers they don't want to headline. Global central banks have liquidated nearly $183 billion in U.S. Treasuries since April 2025. Think about that. The safest asset on Earth is being dumped by the very institutions that are legally mandated to hold it as a bedrock. And where is that money going? It's flowing into a 5,000-year-old metal that surged over 70% this year alone. Gold just shattered $4,400 an ounce, and the reason isn't just inflation, it's a complete systemic loss of trust in the paper system. For 30 years, the dollar was the only game in town, and now it's at a 30-year low, 56%. That's not a dip, that's a free fall in geopolitical terms. The captains are already in the lifeboats. Look at the National Bank of Poland. They added 83 tons this year. Look at India. Their gold reserves just crossed the $100 billion mark for the first time in history while they quietly trim their treasury exposure. They aren't diversifying. They are hedging against the collapse of the rules-based order. This is the De-Dollarization Paradox. The dollar still has functional dominance for trade, sure, but as a reserve asset, it's being treated like a toxic liability. The world is pricing in a neutrality premium. They want assets that can't be frozen, sanctioned, or deleted by a keystroke in Washington. Your savings, your retirement, the price of the coffee in your hand. It's all tied to a currency that the rest of the world is fleeing. And the most terrifying part? For the first time in 3 decades, central bank gold holdings have officially overtaken U.S. Treasuries in total value. The anchor has shifted. The math is breaking, and the mainstream is pretending it's just a market cycle. But there is a hidden mechanism, a unit being tested in the shadows of the BRICS summit that is designed to turn this gold hoarding into a weapon that will finalize the dollar's exit. And once that switch is flipped, there is no going back to the old world. To understand this crash, you have to process what happened in 2022. That was the year that the rules were deleted. When the West froze Russia's foreign reserves, every central bank governor from New Delhi to Brasilia had the same realization at the exact same time. If you don't hold it, you don't own it. They realized that money in the digital age is just a permission slip from Washington, and those permissions can be revoked overnight. That was the spark. But 2025 is the forest fire. The mainstream narrative is that this is just a high interest rate environment or inflationary pressure. That is a total lie. It's a convenient fairy tale to keep the retail investors from looking at the exit doors. The standard argument is always, the dollar is the only liquid market large enough to host global capital. They say there is no alternative. But look at the math. The math is screaming that the alternative isn't another paper currency like the yuan or the euro. The alternative is the only asset that has zero counterparty risk: gold. We're not just talking about a few tons here and there. We are talking about a $4.5 trillion pivot. For the first time since the mid-90s, the value of gold in central bank vaults has officially dethroned U.S. Treasuries. The gap is nearly $1 trillion now. Think about the irony. The safest asset in the world, the U.S. 10-year, is being treated like a hot potato. Foreign banks have dumped over $183 billion of it since April alone. They aren't just selling, they are fleeing. And why? Because the villain here isn't just inflation, it's the total breakdown of institutional independence. You have a civil war playing out between the White House and the Federal Reserve. When you have a president openly threatening to fire the Fed chair or demanding lower rates to pump the market regardless of the data, the rest of the world sees a banana republic trajectory. They see a central bank that is no longer a neutral referee, but a political tool. If the Fed's independence is shredded, the dollar's credibility dies with it. Now, the skeptics will tell you that the BRICS unit is a pipe dream. They'll point to the internal bickering between India and China and say a unified currency is impossible. And they're right, a unified currency is hard, but they're missing the point. They aren't building a currency to replace your grocery money. They're building a settlement unit for the big leagues. It's a digital ledger backed 40% by physical gold. It doesn't need to be stable like a dollar. It just needs to be unfreezable. It's a digital exit ramp from the SWIFT system. When you see gold hitting $4,500 while the U.S. debt to GDP crosses 120%, you aren't seeing a market rally. You are seeing a debasement trade. You are seeing the smart money, the guys who actually print the stuff, deciding that the paper is worth less than the ink. They've watched the interest payments on U.S. debt cross $1 trillion a year. That's more than the entire defense budget. The math says the U.S. can never pay it back without printing more. And if you know the printer is going to run forever, why would you hold the paper? The easy fix they keep promising is that we'll just grow our way out of it. It's a joke. You can't grow your way out of a debt trap when your interest costs are compounding faster than your GDP. They are trapped by their own arithmetic. Every time they raise rates to fight the inflation they caused, they make the debt more expensive to service. Every time they lower rates to save the economy, they fuel the gold fire. It's a checkmate. They just haven't admitted it to the public yet because they need you to be the last one holding the bag. When that Treasury index drops, it doesn't just mean a red line on a Bloomberg terminal. It means your grocery bill doubles because the dollar's purchasing power is being exported to the gold vaults of Warsaw and Beijing. It means the exorbitant privilege of the American consumer is evaporating in real time. We are watching the 1970s on steroids, the same oil shocks, the same geopolitical fracturing, but this time the world has a digital alternative and a gold-backed ledger ready to go. Think of the global financial system right now as a luxury cruise ship. Let's call it the SS Sovereign, where the captain has been quietly selling off the lifeboats to pay for the fuel. For decades, everyone on board felt safe because the ship was too big to sink. But now the water is visibly rising in the lower decks, and the first-class passengers, the central banks, aren't just putting on life vests. They're jumping overboard with bars of gold strapped to their chests. They're trapped in a mechanism that I can only describe as a mathematical suicide pact. Here's the simple analogy. Imagine you're playing in a casino where the house keeps changing the value of the chips while you're at the table. You start the night with $1,000 in blue chips. 2 hours later, the pit boss announces that blue chips are now worth $800 because the casino needs to pay for its electricity bill. An hour after that, they're worth $600 because the owner's son crashed the company jet. Eventually, you stop looking at the chips as money and start looking for the exit. That's exactly what the U.S. Treasury market has become. It's a rigged game where the House, the U.S. government, has to print more chips, dollars, just to pay the interest on the chips they already issued. The math here is it's nauseating. As of this month, the U.S. national debt has blasted past $38 trillion. But the debt isn't the real killer, it's the service cost. We're now paying over $1 trillion a year just in interest. To put that in perspective, that is more than the entire U.S. military budget. We're spending more to rent our past debt than we are to defend our current borders. And here is where the empathy trap kicks in for the decision makers at the Fed. I almost feel for them. Almost. They're staring at a control panel where every button leads to a different version of hell. If they keep interest rates high to stop the inflation that is currently eating your paycheck, they make that $38 trillion debt even more expensive to service. Every 1% increase in rates adds hundreds of billions to the deficit. They essentially bankrupt the government to save the currency. But if they lower rates to keep the government from defaulting, they flood the system with cheap money, which sends inflation into the stratosphere and makes gold the only logical place for a central bank to hide. They're effectively trapped in a feedback loop, where the cure is as deadly as the disease. They're trying to put out a fire with a hose that's connected to a gasoline tank. The pattern is undeniable. First comes the debt, then the interest spike, then the inevitable printing to cover the gap, and finally the flight to hard assets. I know, it sounds impossible. It sounds like something out of a collapse porn novel. But you have to look at the domino effect that is already in motion. Domino A, the debt milestone. In October 2025, we hit $38 trillion during a 23-day government shutdown. The world watched as the world's reserve currency couldn't even keep its own offices open, while the debt clock was ticking at $1 trillion every 100 days. Domino B, the BRICS unit launch. On December 8, 2025, the BRICS alliance didn't just talk, they launched. The unit, a digital settlement instrument, backed 40% by physical gold. This isn't a yuan takeover. It's something much smarter. It's a way for 30-plus countries to trade oil, gas, and wheat without ever touching a U.S. bank or the SWIFT system. It's a parallel reality. The institutional pivot. When you see the National Bank of Poland, a NATO ally, buying 16 tons of gold in a single month while cutting Treasury exposure, the message is clear. Even the friends of the system are hedging against the system's failure. They aren't waiting for a crash. They're pricing in the reality that the dollar is no longer a neutral store of value. The final de-anchoring. We have reached the crossover point. For the first time in 30 years, gold represents a larger share of global reserves than U.S. Treasuries. The safe haven has shifted from paper to metal. The mechanism is now self-reinforcing. As central banks sell treasuries to buy gold, treasury prices fall and yields rise. Rising yields make the U.S. debt interest even more expensive. The more expensive the debt, the more the U.S. has to print or borrow to pay it. The more they print, the more the dollar loses value. The more the dollar loses value, the more gold the central banks buy. It's a whirlpool, and we're right at the edge of the event horizon. The experts on TV will tell you this is just a cyclical rebalancing. They'll use big words like secular stagnation or portfolio optimization to keep you calm. But they won't tell you that they're selling their own dollar-denominated assets behind the scenes. They're telling you the ship is fine while they're practicing their swan dive into the ocean. This isn't about gold bugs or conspiracy theories anymore. This is about cold, hard, unfeeling arithmetic. And the arithmetic says that a system built on $38 trillion of unpayable debt cannot survive a world that has finally found an exit ramp. Look, the optimism is a trap. If you're waiting for a soft landing or a return to the 2010s, you're already behind. The next 12 months aren't just going to be volatile, they're going to be a total structural recalibration of what we define as wealth. By mid-2026, the masks are coming off. We're looking at a gold price target that the institutions, the ones who used to mock gold bugs, are now quietly circling, $5,000 an ounce. Goldman is already calling for $4,900. Some desks whispered $5,300. But the price of gold isn't the story. The story is the inverse collapse of the dollar index. We're watching the DXY drift toward the low 90s, a level of weakness that makes imports, your electronics, your fuel, your clothes, massively more expensive. This is the imported inflation that no one is talking about. And then there's the May 2026 cliff, Jerome Powell's termins. Think about the vacuum that creates. We're heading into a leadership transition at the Federal Reserve in the middle of a sovereign debt crisis. Whoever takes that seat is walking into a burning building with a water pistol. The market is going to test that new chair instantly. If they blink, if they cut rates too fast to appease the political pressure, inflation goes vertical. If they hold the line, the interest on our $38 trillion debt swallows the rest of the federal budget. There is no good outcome here, only less bad ones. The vision of the future isn't a total Mad Max collapse. It's actually more subtle and more permanent. It's a bifurcated world. On one side, you'll have the paper zone, the West, clinging to a dollar that loses 5–10% of its purchasing power every single year, like clockwork. On the other, you have the unit zone, the BRICS Plus bloc, using a gold-backed digital ledger for the world's most important commodities. We are moving toward a reality where the global South doesn't just participate in the economy, they price it. You're going to see a two-tiered society. Those who hold paper assets, pensions, savings accounts, standard bonds, are going to feel a slow, grinding poverty. It's the boiling frog effect. Your balance stays the same, but the bag of groceries gets smaller. Meanwhile, those who moved into outside money, physical gold, silver, maybe select digital assets that the institutions can't dilute, will be the only ones with the liquidity to buy the fire sale assets when the bond market finally breaks. So what do you actually do? You stop listening to the everything is fine crowd and start acting like your own central bank. First, mental fortitude. You have to unplug from the daily price action. This isn't a trade, it's a transition. If gold dips to $4,100, the mainstream will scream, "The bubble burst." They said the same thing when it hit $500, then $1,000, then $2,000. Ignore the noise. The math of $38 trillion in debt is the only signal that matters. Second, the hard asset pivot. This isn't just about gold bars under your mattress. It's about productive assets, land, skills, tools, anything that the government can't print into obsolescence. You want to be positioned in the real economy. If you're 100% in digital paper, you're 100% at risk of a keystroke default. Third, community resilience. When the dollar loses its status as the social glue of the world, local trust becomes the new currency. Who do you know? Who can you trade with? The lone wolf strategy is a myth during a currency reset. You need a network that operates outside the traditional banking friction. We are entering the era of fiscal reality. The era of free money, cheap imports, and consequence-free deficits is dead. It died the moment the central banks decided gold was safer than the U.S. Treasury. The patterns don't lie. History is just a series of currency cycles, and we are at the 11th hour of this one. Don't be the last person trying to trade your lifeboats for more deck chairs. The water is already at the door. Trust the patterns, not the promises. I'll see you in the comments.